My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
All right, guys, welcome back to Property Profits Podcast. I'm your host, Bryce Kaminsky, filling in for Dave Dubow. And today on the show, if you've ever thought, I've got a lot of real estate, it's pretty linear, maybe I should start diversifying, it's probably something you should have started thinking about before that point. And today on the show, I've got Brian Henning. He's going to be talking to us a bit about that diversification that we should start planning for before we actually need it. Brian, how are you doing today?
Great. Thanks so much for having me. I appreciate it.
Yeah, no problem. It's my pleasure. So the big question that every conversation in real estate happens, especially for people who are thinking about getting in or people who are, already a little bit maybe knees deep in the water, how did you get addicted to real estate? Because I think we all are a little bit addicted. So what got you hooked?
Yeah, for sure. Happy to share that. So for me, it actually started out in stocks, actually, and just investing in general. I had an economics teacher in high school that had us track stocks in the newspaper, and that was kind of dating myself a little bit there, but that was kind of how he was kind of trying to teach us about investing and the economy and so forth. And so that kind of put a little spark in me. And so then once I graduated high school, I started going to the library, checking out books. This was before the internet was so big, and just kind of trying to learn as much as I could about investing in stocks. And then probably about a year and a half later is when I started working for a large financial services company here in San Antonio, became a stockbroker. So I had my 765 licenses. So I did that for about a decade and got to learn a lot, got to learn a ton. It was super exciting. But during that time, I started investing in real estate on the side. My very first investment was a HUD foreclosure that I moved straight out of my parents' house into, and actually kind of house hacked from day one. I rented one of the bedrooms to one of my coworkers at work, and it was a little fixer upper. It just needed minor stuff, carpet, paint type stuff, and that was kind of what got me into the real estate bug. And then I started doing some flips in single family rentals, got into small multifamily, dabbled in Airbnb a little bit. And then in the last few years got into some larger commercial type projects.
Okay. And so when you got started, big angle on the podcast here, people always want to know, how did you pay for it, Brian? How did you put the deal together? Where did you get that funding for those first couple of projects?
Yeah, so for the first project, for the first house, I got a traditional loan. I had a decent job, so for the second project, which was my first flip, I actually got a regular 30-year mortgage on it. I had no idea what I was really doing, so I just got a 30-year mortgage, and that was kind of my plan. And then I ended up just it was one of those things where I was standing on the front porch of the house, and my real estate agent at the time, who was also a real estate investor, he knew I'd read a lot of books, done a lot of self-education on stuff. And I was standing there just kind of hemming and hawing about whether I was going to do it. And he was like, look, man, you're at a paralysis by analysis standpoint here. You got to do something. And so I just kind of pulled the trigger and bought it. I think I made like $800 on the property, but I didn't have a contractor lined up. I actually got a contractor from the neighbor that lived next door. So, I just kind of went for it. And so I learned a ton. It was that classic story of, you shouldn't fix up a house like you're going to live there. And I did that. So I over improved it, was really picky with the stuff. Yeah. It turned out beautiful and turned out great. And I made a few bucks on it, but I figured, making a few dollars on education is, not a bad deal versus having to pay for it.
Back out, right?
Yeah. Yeah.
So, the over renovating and like learning the things, did you ever move from self-education into something more formal with there's tons of programs out there, tons of coaches and mentors that can kind of collapse that time frame? Did you ever take any of that, or are you like a self-made guy in that sense?
I did do some of that when I started getting into the commercial projects a few years ago. That
Yeah,
was kind of a big leap from doing single family into 100+ unit apartment buildings and syndications and stuff like that. That was a little bit
yeah,
of
a
a
lot
learning
to learn.
curve. Yeah. And so I did join a local mastermind group here in San Antonio to help kind of expedite that process. It was a game changer for me from the standpoint of, learning a lot, but bigger than that, getting in a room with people that were actually doing deals
Yeah,
and
that energy, right?
right, that energy and making it real, right, and attainable.
Is
So there's
that
been some
club
bumps and bruises, but yeah,
still kicking around?
it is. Yeah, it
You want
is.
to
Yeah.
name drop it just for people thinking about to run in there?
Yeah, sure. It's called Apartment Educators here in San Antonio, Texas. One thing I will say, this is just my personal opinion. I do
Hmm.
think that people should stick to if they want to find a mastermind group. I think they should try to find one local to their area because I think
Yeah.
being able to meet with people in person is like huge.
And
That
offline too, right? After the meeting and go to
go
the
have
Dunkin's
coffee
Donuts
or
and grab, the crazy coffee with all the sugar on top.
right.
Yeah, so I definitely agree. The local network is got the insights on what's happening locally. So, I always believe that with mentorship and stuff. Like if you're gonna be doing something, you should be finding someone who's doing it, and even better if they're in your backyard. Not always, it's not always a case that you can find that, but it's definitely a bonus if you can. So, um, you did some flips and you've kind of grown progressively, which I like because some people try to skip steps and they get burned or they flatten out and they just blow up.
Mhm.
So now you're into multifamily. So you mentioned syndication. So you're part of funding larger projects with other people and partners. Tell people a
Mhm.
little bit about how you got your first taste of that sort of bigger multifamily.
Yeah, I mean, it was, really just kind of jumping in once I had gotten that education and started learning from people that were doing deals and stuff like that. I would help other roles, but I would also help bring capital to the deals and things like that. And so that was a big learning curve. There's a lot of SEC regulations around
Hmm.
syndications and stuff like
Hmm.
that people really have to understand before you jump into that business. And that was one of the good things about joining the group. And I would say before you even start becoming a part of a syndication or doing anything like that, you should find an attorney, whether it's one associated with the group that you're working with or another one, but a securities attorney that can help outline a lot of things for you. I would say too, going with somebody that's a little bit conservative is not a bad thing.
Yeah.
Because the concern is that you're doing things wrong, and having been a former licensed stockbroker and financial advisor, and been on the SEC's so to speak radar just because I was licensed. I can appreciate some of that, and so I think that's super important to just make sure you're doing everything above board. So
Yeah, I find as a real estate investor myself, I'm very excited, very let's go, let's go, let's go. And if you're that type of person, and I think you're alluding to that, is like find a lawyer that is always asking the question, like, what if it doesn't go right, Bryce? What if it doesn't go that way? And then you sit there and you say, yeah, like especially when I'm doing creative financing, he's like, what about this, that, and the other? And you're like, good blind spot. Thank you very much. I'm going to go
yeah.
address that and we'll come back to the table and do that. So definitely finding that someone to question you in a sense to make sure that you've kind of thought it all out, especially with syndications and multifamily, because securities from province to province in Canada change, and I'm sure state to state securities has different nuances. So
Mhm.
now that you've kind of got your feet wet in that, where is that taking you?
Yeah, so I've been a part of multiple partner on multiple different multifamily deals. This was so in some ways I started doing this at the worst time, and in some ways I started doing it at the best time. A few years ago was when I started getting into syndications and multifamily. So obviously, there was a lot more capital. The interest rates were so low, people were a lot
Hmm.
happier, so people were a lot more open to investing at that time. So that was a good thing. Rates were low. That was great at that time. The negative part now is, of course, a lot of those multifamily deals are bought on bridge debt. And so those rates, as rates go up,
Hmm.
the cash flows, get reduced and dwindle. And so that becomes a challenge. And there's properties that I'm a part of right now that are, we're going through our bumps and bruises, and it's a challenge. And it's one of those things where you can't you wish you did some things differently, but you can't go back. So all you have to do is learn from that, try to
Mhm.
make sure that the things you do going forward, you learn from some of those mistakes you've made in the past, and learn and adjust. And so that's why I've kind of changed my strategy up a little bit, and how I'm doing the syndications, and with the fund that I started and so forth. So just trying to kind of incrementally learn. It's always better to learn from other people's mistakes, but sometimes
Mhm.
you have to learn from your own. So
Yeah, well, someone in the history of things has to be the first to learn it. Now, the other thing I like is this, the saying goes, everyone's a genius in an up market. So everyone's
yeah,
running
yeah,
around, I just got 300 doors, and it's like, okay, you've got 300 doors, hold on to them now. Hold
yeah,
on to them.
yeah. Can you
And
hold on
yeah,
to them? Yeah,
can you hold on to them through the
yeah.
thing? So being creative, being flexible. I know with the multifamily, there's a lot of moving components. How do you manage the day-to-day of all the different moving parts of these syndications and these multi-unit deals?
Yeah, so for these multifamily deals, you've got a general partnership team of maybe a handful of people, and everybody kind of has different roles, and usually the lead sponsors, meaning the ones that find the deal and do the
Hmm.
original underwriting and due diligence on it, they'll be the asset manager as well, and so they'll be the primary point of contact to the property management and stuff like that. And so
Hmm.
so property management companies are a huge piece of the puzzle, is making sure you've got a good one. I mean, we've had to, on a few of the deals I've been involved in, we've had to change property management companies. It's one of those learning lessons too, right? When everything's going great, right?
When all the
The
rent's coming in, there's
all the
not one to
rents,
call, but
yeah,
where's
and
the rent?
rents are increasing 10-15% a year. Things look great, expenses aren't as glaring, but then when things start going down the other way, it's like, okay, well, now you start looking closer at things. And so that's been a challenge. I sometimes I say, and this is a little obviously an exaggeration, but it's just to drive home a point. I really do think that my 12-year-old daughter probably could have made money in real estate syndications over the last 10 years or so, because it
Yeah.
was just with rents going up so much, with money pretty much being free, and for so long. Not to, I'm exaggerating obviously, but it wasn't as hard. Now, right now is the time where, okay, this is the people that can survive and can continue to do it through these tough times. Those are the ones that will have those battle scars, and have,
Hmm.
as long as they've learned from those lessons, I think we'll be really much better on the other side of this. So
Yeah, you look at historically the late 80s into the 90s, and you're seeing the similar thing, interest rates creeping up, people like putting keys in mailboxes and walking away. And I don't want to be
mhm.
too doom and gloom, but the reality is that most most of the wealth and most of these large pickups are happening on the backs of the overzealous investors. They're like, the biggest property management company, the biggest owner of property like apartments, multi-unit in Winnipeg, at the point where they took over the portfolio, the bank had asked them first to manage it, and there was no buyers, and the bank's like, we don't want to keep carrying this. Do you just want to have it? Like, do you want to just have these things? And yeah, we'll give you a good term and a good mortgage, and like you're already managing it. So it was really the people that survived were able to benefit the most. So stay conservative out there, and I think you'd agree. Stay conservative, stay persistent, but also, whenever there's a fire sale, things are on sale. So,
Yeah.
I think those are definitely coming. How are you guys managing the finances as far as the capital and things like that? Because they are tighter.
Oh yeah.
So are you going to private funds? Where's the capital coming from these days, if not the bank?
Well, so I haven't been part of an acquisition on a property for probably, I don't know, I guess it's probably been a year now. So
Hmm.
we haven't really acquired anything. Me directly in my fund, I've acquired some things, but it's, yeah, I mean, it's still a huge challenge. And some of the existing properties that we have now, we're having some capital challenges too, just because they're not cash flowing as good,
Hmm.
or break even type situations. And it's just it's a reality of where we are in the market right now. And I think a lot of people, you know, me included, didn't think that rates were going to go up as far as they did, as fast as they did, right? And
Mhm.
so that took a lot of people by surprise. I mean, I
Definitely.
know so many operators and ones that are super experienced that have been doing it for a long time that got caught up in some of this stuff as well because when bridge debt is the way to go for so many years and then everything shifts what feels like overnight,
Yeah.
it's a challenge. But one of the things about the bridge debt, yes, it fluctuates, but you buy these rate caps, right, which are basically insurance policies to protect you on the upside. The banks require it. But the reason a lot of syndicators buy those is because there's less fees to sell when you go to sell it later on, right?
Mhm.
But then the flip side to that is where we are now, and that wasn't rates weren't an issue for so long, so it made the most sense. But yeah, some are definitely a challenge now, but there's still deals happening.
Yep.
There's plenty of deals happening that with the operators that have the capital and have the experience and have gone full cycle on multiple deals. The banks are still willing to lend to.
Mhm.
And I think you alluded to it earlier, said it, there's going to be some fire sales. There's going to be, there's been a couple of deals that I've been a part of that we picked up in the fund that were just that. They're from distressed sellers that were in, some similar situations where they really need to get out. So
Yeah, we also have that. We're seeing a lot in the multifamily space, especially in Canada. We don't have a lot of multifamily. We've got a 40 million population spread around like 200 kilometers from the border. For those of you in America, that's like, I don't know, 75 miles or something.
okay.
So we're very close to the border in the majority, and they just didn't have a need to build these, the density of multifamily. So the people who bought them were coming out of the 90s. So if you think about it, I'm 39. Let's say I'm like motivated and I go and I buy something in the 90s. How old am I in 2023? Okay, 10 years, 20 years, 30 years. I'm 40, I'm 65, and I'm like, I've had enough. I've kept it well, but I've
Yeah.
been managing it and cutting the grass. And it's time to go to Cuba for the rest of my life. So we're seeing that. I'm seeing. What are you seeing as far as like where these deals are coming from?
Yeah, I mean it's a lot of other syndicators. So I'm really mainly focused in Texas. That's where
Hmm.
I'm based out of. That's where I'm born and raised. So that's really where I've primarily focused my investing in. It's just what I know the best, right? I passively invest in some other areas as well, but yeah, it's a lot of syndicators that are just in a position where they need to sell. I mean, they're a lot of these bridge debt loans are 3 year, they have a 3 year term, and then you have like a 1+1, right, where you have opportunities to kind of re-up the loan. But if you're not meeting certain criteria, the bank may not let you, and
Hmm.
or they're getting to a point where rates have gone up so much they're kind of at a break-even point cash flow wise, but the bank's requiring, maybe they have a 3 year loan, but they got a rate cap for 1 year or something, and so now they have to start escrowing 30 grand a month for another rate cap,
Hmm.
things like
Hmm.
that. And so and that maybe there's not enough capital across the general partnership team, or no
Or they're
investors want to
tired of
put in any,
investing.
or
Yeah.
they're tired of, yeah. So it's just there's a lot of what's happening right now is a lot of people are getting weeded out basically, and so
Yeah.
that happens that's what happened in 2008 too, right? I mean,
Hmm.
I was
Hmm.
investing at that time in single family. That's actually when I picked up most of my single family rentals, was right after that. Some
Yeah,
great
there was a few.
opportunities.
There was a few houses
Yeah,
to
there's a
buy
few
in
on the market.
2008.
Yeah, yeah, yeah.
So where do you
I
see things going over the next like three? Let's talk about like towards 2030. Where do you see things going?
Wow.
Where's the opportunity for a 20-year-old version of us looking at it going, should I?
Yeah, I think residential is still great. I can speak, especially for Texas, whether it's single family, small multifamily, large multifamily, anything residential, there's still a housing shortage. We
Hmm.
have so many people moving to Texas from other states like California. And
Yeah, I
so,
wonder why. Why would you
yeah,
like to move
yeah,
from California to Texas?
exactly. Yeah. Yeah, without getting political, there's several reasons why
Even
they would do that.
landlords, like
Oh,
we're
yeah.
having that in Ontario right now, where I saw this post. It's wild. The landlords, the association is blocking like people from being evicted. They're still like the board is really against them. So landlords are going out and spray painting pay your rent on their own buildings. So let the neighbors know that these people aren't paying. And they already know, but it's the landlords are starting to take it into their own hands because of the the regulations of the board that allows them to, change the tenancies. So I definitely know why people want to go to Texas, because Texas is the
The
land of the
landlord
free,
friendly.
truly,
Yeah,
truly,
yeah, it's a
right?
landlord friendly state for sure. California
Yeah.
is not. And and I know I haven't been investing in real estate for over 20 years. I mean, it is interesting how landlords get a bad rap. I know there's some bad ones out there, but the reality of it is there's also a lot that it's their livelihood, just like anybody else. It's their job. And so by constraining and holding and cuffing their hands, you're yes, maybe
It's a
you're
regulated
temporarily.
business, right? It's
Yeah,
regulated.
yeah, yeah. I had real funny, just real quick. I'll tell you, I had a couple of mobile homes that I owned, and I had one of the tenants. This was during COVID, and when President Trump was in office, and one of the tenants called me up and was like, "Hey, I called her and I was like, do you have an update on the rent?" And she's like, "Oh, well, the president said I didn't need to pay my rent." I'm like, no, that's not exactly how you kind of misinterpreted that." So yeah, you can't be evicted, but you still owe that rent. And anyway,
Hmm, hmm.
so it's just funny.
Well, everyone's like, oh, landlords are making it so good. They're making off with all my money. I go to work. Remember, guys, when it's empty, who's paying that mortgage? The
Right.
landlord, right? So,
Yeah.
there's risk and reward. And so, don't hate on the landlord who's willing to put his own money into that thing when it's empty. So there's a lot of risk that comes with being a landlord, damages, tenancies, regulations changing. So
Yeah.
it's not easy, but definitely there's a reward in it for someone who can stay the course. So as we move towards 2030, where do you see things going?
Yeah, I do think right now is, like I said, I think it's still a great time for residential real estate. Housing shortage, and really the housing shortage is kind of across the country.
Mhm.
Back in 2008,
Canada
right?
too.
Yeah, yeah. I mean, 2008, a lot of builders stopped building, and there was a lot of properties. But the reality of it is we've never recovered for that. And then you have COVID, where that slowed down, and now with the rates so high, things are slowing down, and nobody's selling because they have a 3% mortgage. And I know it's
Yeah, where are
different in
they going to
Canada.
move to, right?
I know it's different in Canada, but like we get that 3.5% mortgage for 30 years. Like, why would you move anywhere else at that point? You're
Yeah,
not
we've
going to
got
get as
like
much home.
2 and 3% for 30 years, but people are renewing now. The renewals are coming up
Right.
and they're 6, 7%, as well as like there. This is an interesting thing. So in Ontario, and especially in these big cities, like much like let's say upstate New York, where things are like really expensive and the bricks and sticks don't match the valuation, right? They're doubling out their amortization. So they're like, you can keep your payment, but now you're talking about like an extension of your 30-year term. So now we're talking about like a
Oh,
60-year
wow. Wow.
amortization. So you're not even gonna be around for that. So they're
Yeah.
doing they're doing all sorts of wild things to keep people in their houses as these interest rates adjusted. And I don't think all the spending was something that people could get around. The money's got to go out, it's got to come back. That's currency, right? So
Yeah.
um, time flies when we're having fun here. Where can people get a hold of you? What's the best way to reach you right up the middle to see if they can do business with you or if they just want to reach out?
It's about 10 different ways. No, I'm just kidding. So best way, the best way is LinkedIn, I would say. That's the only social media that I'm on. So they can just look me up under Brian Head, under LinkedIn. That's probably the best way to get a hold of me.
Yeah, LinkedIn's a great platform, especially for the professionals. So find Brian
Yeah.
on LinkedIn. And until next time, guys, we'll see you on the next episode.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.